I would like to discuss the risk of real assets impact investing. What investors should be familiar with. And while real asset impact investing has many advantages, there are also several disadvantages to consider. And so here are some key drawbacks that is inherent in this nature of investing. Number one is illiquidity. When it comes to liquidity, real assets are often illiquid, meaning they cannot be easily sold or converted into cash. This can be a challenge if investors need quick access to their funds. Compared to the stock market where you can key in the buy order and almost simultaneous and almost immediately your order is executed. You could buy, you can even sell, almost without much effort. When it comes to real estate or real assets, it takes sometimes months to be able to dispose of an asset. Number two is high initial capital requirement. Investing in real assets usually require a significant investment, making it less accessible for smaller investors or those with limited capital. This nature of investing actually has to do with it will really involve people with large amount of capital outlay. It's not just for people with smaller amount of fund. It's for high net worth individuals, institutional investors, and people with the wherewithal to be able to partake. Number three is management complexity. So real assets often requires active management, including maintenance, property management, and compliance with regulations, which can then be time-consuming and costly. For you to be able to invest successfully when it comes to real assets and impact investing, you will need a property manager, a skilled, experienced property manager, and you will need to equally comply with different local regulations when it comes to this form of investing. And of course, it's quite laborious and time consuming. Number four is market risk. The value of real assets can be influenced by market fluctuations, economic downturns, as well as changes in supply and demand, potentially impacting returns. If the economy is on a downturn, it will definitely affect real asset prices. And if the demand is actually low, it will equally affect the price. And all these factors come together to really impact negatively real asset impact investing. Number five is regulatory challenges. Investing in real assets may involve navigating complex regulatory framework, zoning laws, environmental regulation, which can complicate the entire investment process. You want to build a structure, you look for zone, you have to comply with the zoning laws that are relevant, that are common in that particular locality. Not only that, you have to equally comply with environmental regulations and other regulatory framework. It makes the entire investing process somewhat frustrating. It makes it somewhat difficult. Number six is geopolitical risk. Risk. Real asset investment, especially in infrastructure and natural resources, can be susceptible to geopolitical risk, including changes in government policy, political instability, as well as international conflict. Whenever there is conflict, there's instability, there is no peace or tranquility. This in condition will certainly affect real estate investing negatively. Please subscribe to this channel and like this video if you've not done that. Number 7 is environmental risk. When we talk about environmental risks, we are considering uh, factors like natural disasters, climate change, and other environmental factors can adversely affect the value and performance of real assets, especially in sectors like agriculture as well as in real estate. So environmental risk is worth considering when it comes to investments in real assets. Number 8 is higher operating cost. Higher operating cost. And so managing real assets, often incur a higher ongoing cost compared to traditional financial assets, including maintenance, utilities, and insurance. Let's take a building, a typical either commercial or residential building. You have to factor in maintenance, regular maintenance. You equally, have to take into consideration utility supplies to the building, as well as some necessary insurance. So all these factors tend to cause the cost of this nature of investing to be very, very high, relatively high. Number 9 is limited diversification. And so, depending on the type of real asset selected, investors may find it difficult to achieve broad diversification within portfolio, increasing risk exposure. It's very difficult to diversify. With this nature of investing, you can't diversify easily like stocks. You cannot diversify like mutual funds and other related investment vehicles. So it's difficult to diversify, and this will force you to concentrate your portfolio, and by so doing, that particular abnormal exposure to risk. Number 10 is impact measurement challenges. How do you measure impact? Because traditional accounting metrics may not be able to adequately, measure impact. So measuring the social or environmental impact of real assets can be complex, leading to potential difficulties in assessing the effectiveness of investment and achieving desired outcome. How effective is the investment? What about the desired outcomes? These factors are kind of a little bit difficult to calculate or to arrive at because of the complexity in measuring these factors as it relates to real asset investing compared to what is obtainable in traditional stock market investing. Very easily you could do all those calculations and arrive at whatever returns or impacts, as the case may be, you need to obtain. So these disadvantages highlights the need for careful consideration and due diligence when engaging in real asset impact investing, assuring or ensuring that investors are fully aware of the potential risk that is inherent in this nature of investing.